In this video, we are going to talk about accounting assumptions, principles, and constraints. GAAP has been established as a way to standardize the presentation of financial information, and FASB bases GAAP on several key theoretical assumptions, principles, and constraints. The accounting principles and constraints are extremely interesting, and we're going to constantly get back to them throughout the day. The accounting assumptions are probably a little bit more obvious, so let's go through them fairly quickly. The first assumption is that the entity is a separate enterprise apart from its owners. In other words, a corporation is a fictional being and has a name as well as a birth date and a birthplace, which is the incorporation date and place. And it's engaged in clearly defined activities and reports its financial health through financial reports to the general public as well as paying taxes, again, distinct from its owners, and can file lawsuits, etc. The second assumption is that the entity is a going concern. That means it's going to remain in existence indefinitely. And what that actually means, this assumption actually has some real relevance for us. And what that means is, imagine a company that is going bankrupt, that you don't assume is going to remain in existence indefinitely. The way in which you value the assets of a business that's about to sell off its assets in liquidation or fire sale prices is going to be different than if you assume that the company is going to be in existence indefinitely. And so that's what assumption number 2 is about, really. That we identify the value of assets and liabilities at a valuation that reflects a going concern as opposed to, say, a liquidation or something of that nature. The third assumption is that financial statements can only show measurable activities of a corporation, like its resources, like its assets or liabilities, the amount of taxes facing it. So that excludes things like customer loyalty, employee satisfaction, environmental awareness, things that may have value but are a little bit more nebulous or difficult to quantify. The fourth assumption is periodicity. Companies are required to file annual and interim reports, and in the US and many other countries, we're talking about quarterly reports and annual filings as the required periodic filings that companies have to make. Accounting year is frequently but not always aligned with the calendar year, which means for many companies, January 1st to December 31st is their fiscal year, which is also the calendar year. And examples include ExxonMobil and GE as well as many other companies. But then you have a lot of companies whose fiscal year ends at a date that is different from the calendar year end. So Microsoft ends June 30th. Walmart ends January 31st. Apple ends September 29th. All have off-calendar year fiscal year ends. So to wrap up this quick section, we covered the 4 underlying assumptions in accounting. One, that the entity is its own separate entity, and that's the accounting entity. The second assumption is that the entity is a going concern. We're going to value assets and liabilities as if the company is going to operate indefinitely. Third is measurement. You only identify things that you can measure. And the fourth is periodicity, that you have discrete periods that you account for. So annual, interim in most countries represents quarterly, certainly could be half-year periods as well. Let's now turn to the major underlying accounting principles. The first and critical assumption underlying GAAP, or I should say principle underlying GAAP, is historical cost. Financial statements report companies' resources at an initial historical cost. Let's assume that a company purchased a piece of land for $1 million 10 years ago. Under US GAAP, it'll continue to record this original purchase price, typically called the book value, even though the market value, which is referred to as fair value, has risen to $10 million. So some of you may already be wondering, why is such undervaluation of companies' resources required? Obviously, this would dramatically undervalue the value of the land that you're carrying on your books. And the reason is very important. It represents the easiest measurement method without a need for appraisal and revaluation. The second is that marking resources up to fair value allows for management discretion and subjectivity, which US GAAP attempts to minimize by using historical cost. It should be noted, though, for those of you who are going to be dealing with companies outside of the United States, IFRS companies, is that IFRS is far more willing actually to allow this subjectivity and avoid misrepresenting the true value of assets. In fact, IFRS allows a deviation from historical cost for the valuation of assets. It allows for writing assets up. But interestingly, the high cost and lack of certainty around appraisals have limited the adoption of this possibility. So IFRS actually lets you write up assets to fair market value, although virtually no companies take them up on that option. Most companies, both under US GAAP and under IFRS, still end up using historical cost accounting, where the value that's representative of assets represents the historical value. The next two principles are perhaps the two most important and challenging principles of accounting. And those two principles are revenue recognition and the matching principle, and they really underlie the basic essence of accrual accounting. Accrual accounting governs the way that a company records its revenues and associated expenses. Specifically, accrual accounting dictates when you recognize revenues and when you recognize expenses. It'd be real simple if we just recognize revenues when we receive cash and recognize expenses when we pay them out in cash. That would be cash accounting. But that is not the accounting method that's used by corporations or that is allowed by GAAP. Accrual accounting is what's dictated by GAAP, and there's a very good reason why that's the way it is. So let's get into that. The first of these two principles is revenue recognition. The accrual basis of accounting dictates that revenues must be recorded not when the cash from those revenues has been received, but when the revenues have been earned and measurable. The next principle, principle 3, and that's the matching principle, dictates that costs associated with making a product must be recorded during the same period as the revenue generated from that product. And so the easiest way to understand that is going through a simple exercise. So imagine Amazon selling a book. And here we see below that there are 4 distinct transactions that have taken place, or 4 distinct events. The first is in June of 2013, where Amazon.com purchases a book from a publisher for $10. Several months later, or I should say a year and a half later, Amazon.com receives a $20 credit card order for that book that it's been marketing on its website. A week later, the book is shipped to the customer, and several weeks later, Amazon receives cash from the merchant processor. Based on these 4 events, when should Amazon record the revenue? If we're using accrual accounting, the revenue is recorded when it is earned and measurable, not when Amazon received the cash, and not even when it received the $20 credit card order from that book. It is when the book was shipped to the customer. That is when the revenues were earned. The next question is, when should Amazon record the expenses? And from the matching principle, we understand that it's not on June of 2013. We do not recognize the expense on the date that you actually had to pay $10 in cash to the publisher, but rather when the book was shipped to the customer, when the revenues were earned. And this is the essence of accrual accounting, that revenues are recognized when they are earned and measurable, and under the matching principle, the costs associated with those revenues are recorded during the same period as the revenue generated from that product. Let's talk about this a little bit further. Why can't companies, or why shouldn't companies immediately record the revenues and expenses? Say when they got the cash from the revenues or when they had the cash outlay for expenses. Well, according to the revenue recognition principle, a company cannot record revenue until that order is shipped to a customer. Only then the revenue is actually earned and collection from that customer who's using a credit card is reasonably assured. And why shouldn't Amazon record the expense when it actually bought the book? Well, the matching principle dictates that we only recognize the expense at the same time that the revenue was sold. We're going to talk about the logic of that, the underpinning logic of that. But this becomes very important when you're building the financial statements that we're about to build. And the essence of sort of what's driving the reason for accrual accounting is that GAAP wants to give investors and consumers of the financial information a better picture of how profitable the business is. If you were to present the original expense divorced from the corresponding revenue, it would be very difficult for an investor to understand what the core profitability is of the business. Of course, the downside is you're not seeing what's happening to cash, but FASB and US GAAP do have an answer to that in the form of a cash flow statement, which reconciles accrual accounting to cash accounting. But we're getting ahead of ourselves. There is an interesting difference between US GAAP and IFRS when it comes to revenue recognition under accrual accounting. And that difference is that US GAAP is really, really specific about when you recognize revenues for a whole bunch of industries, specifically industries with unique issues in terms of recognizing revenues over long periods of time, like software and real estate. IFRS is much more loosey-goosey. They provide general guidelines, but they're not nearly as specific, which leaves a lot of room for interpretation. And so although both US GAAP and IFRS both use accrual accounting, both require accrual accounting, and both generally have the same guidelines, just keep in mind the US GAAP is a lot more specific when it comes to industry-specific issues. The last principle is principle 4, and that's full disclosure. And under the full disclosure principle, companies must reveal all relevant economic information that they determine to make a difference to its user. So such disclosure should be accomplished in the following sections of the company's reports: financial statements, notes to financial statements, and supplementary information. We have just covered the 4 underlying principles in accounting: historical costs, accrual accounting, specifically revenue recognition, and the matching principle. And lastly, we talked about full disclosure. We now turn to the major underlying accounting constraints. The first constraint is a fairly straightforward one, and that is estimates and judgments. Certain measurements cannot be performed completely accurately and must therefore utilize conservative estimates and judgments. For example, a company cannot fully predict the amount of money that it will not collect from its customers who, having purchased goods from it on credit, may ultimately decide not to pay. Instead, a company must make conservative estimates based on its past experience with bad customers. So the nature of accrual accounting is such that since you're no longer just capturing expenses and revenue based on when cash is coming in and going out, you then have to start making assumptions. And this is the first constraint. Constraint number 2 is materiality. Inclusion and disclosure of financial transactions in financial statements hinge on their size and effect on the company performing them. So note that materiality is going to vary across different entities. You're required, the second constraint is that you have to present things that are material. But a material transaction for a local lemonade stand is going to be immaterial for General Electric, whose financial information is reported in billions of dollars. So materiality to one company is different from materiality to another group, and that obviously introduces some subjectivity into these constraints. The next constraint is consistency, and that means that each company has to prepare financial statements using a consistent set of assumptions and techniques. In other words, you can't jump from one set of assumptions and estimates in one period to another in the next period, because that obviously introduces possibility for manipulation. So imagine a situation in which a company values inventories using one way, where you value inventories based on what's called LIFO, last in, first out, which we'll talk about later on in the course. Last in, first out means that if in periods of rising prices, the last inventories that are coming in are going to be the first ones that are recognized out the door. That means you're going to have a lower value of inventories that remain in stock, because all your high-priced inventories are leaving out the door first. And this is sort of an accounting method, which we'll address. But if you could switch from that accounting method to first in, first out, or FIFO, from period to period, you could sort of change the way that your inventories are valued from one period to the next to show the results that you desire to get across. And so consistency prevents the ability of companies to really manipulate how they present financial information. The fourth constraint, and perhaps the most important constraint, is we always want to operate. Under GAAP, they always want companies to operate with a conservative bias. Financial statements should be prepared with a downward measurement bias. Assets and revenue should not be overstated, and liabilities and expenses should not be understated. And this is sort of tied into the historical cost principle. In fact, you can think about the historical cost principle, which requires a company to record value of its resources at an original cost, even if the current market value is considerably higher. That's an example of a conservative bias. And in this slide, we lay out the summary of all the accounting assumptions, principles, and constraints. Perhaps the most important ones that we talk about are the historical cost principle, as well as these 2 revenue recognition and matching principle assumptions. These concepts lay at the heart of understanding how the financial statements interrelate. And we're going to be spending a lot of time talking about that throughout the course.